Because I went ahead and played with it. I made a path for you. There's no bad borrower, it's just a matter of time borrower.
Hey, JD here and Chase with the 256 team at Rosenblum Realty. We are here with Tyler Wilson of the Clear to Close team.
Absolutely.
With loanDepot.
Thank you. ClearToClose.com. The thing is that there's the housing ratio, which a lot of people forget about, and the debt to income ratio. So let's say we're above a 580 and you can go up to a 40/50 on a manual underwrite. A manual underwrite means that the government's automated program didn't give you an approval. So I gotta kind of give you that background on it. You know, I've been talking about Fannie and Freddie. Fannie Mae uses an automating system called Desktop Underwriter. Freddie Mac's they just changed, was it Loan Prospector, whatever it is, LPA. And we take your credit score, your credit profile, your FICO algorithm that all lenders use. That's another subject of what algorithm we use compared to what consumers think their scores are, etc. So we use the FICO algorithm that goes into the automated underwriting system. The loan application that hey, we gotta take your application. You hear us talk about that? It's called the Uniform Residential Loan Application. Mine looks just like every other lender in the nation. It is uniform. All of us use the same thing. That electronic format's called a 3.2. So it's called a Fannie Mae 3.2 file. So we get it on a PDF or whatever, but one day it gets put into this format. So you take that and then you put these things into the automated underwriting system. How much money do they have in the bank? Well, they don't have any money, so you gotta refer. Well, they didn't get approval for a down payment when you didn't put any money in there. So then you put some money in there and then you get an approval. And then you can put gift funds in there, came from money markets, whatever it is. So, I mean, that's what we do. Like, that's our operating system. When you ask us to pre-qual somebody, they apply online, they put that information on that uniform residential loan application, and we run it through that system. Some loan officers are only as good as that system. I don't want to say manipulate it, but it is garbage in, garbage out. I do sometimes have to create boxes. Hey man, you don't qualify right now, but if you had $3,500, 2 months in reserves, I have an approval. Because I went ahead and played with it. I made a path for you. There's no bad borrower, it's just a matter of time borrower. So you might not get an automated approval. And if we don't, it's called a refer. If you get a refer, then we're back to where I've been talking about manual underwrites. So manual underwrites just means that, always a human's pretty much gonna underwrite a file, right? Somebody's always gonna lay their eyes on it, etc. But a manual is more scrutinized, more hoops that you have to jump through, more regulations, smaller box to fit in. So on those ratios, you can go to certain levels if you have compensating factors. So like 31 on the front end, 43 on the back end, you don't have to have any compensating factors. You get 37 and 47, so 37% front end ratio. Front end ratio is how much is your house payment compared to your income. Debt to income ratios, credit cards, auto loans, what is that compared to your income? So you can go higher on the back end than you can on the front end. You can go up to a 50% DTI, but your house payment can't be 50% of your income in the manual underwriting scenarios. So you can be 37 if you have one compensating factor, means 1 month reserve. So you can go higher if you have 1 month reserve. If you've got 1 month reserve and a minimal increase in housing payment, so let's say I rent for $1,000 a month now, and my new house payment's gonna be $1,100. Well, that's a minimal increase. There's not much change there. So that's another compensating factor. What I can show proof I paid on time for 12 months, I can continue to do. So now I can go to the 50% DTI range. So you have to have these tiers and buckets, right? So that's why I said it's complicated as far as not a straight across the board answer. And then sometimes, you just kind of tweak it and you tell folks, hey, sorry, you're below 580. It's cut and dry. It's 10% down. Here's the ratios you have to fit into. There's not much wiggle room for you. And then so do we enter into like credit repair conversations and enroll in some program? Do we need to save up money? Do we need to pay stuff down? Do we need to refinance autos out of your name? Do we need to consolidate debt? Like, that's where the real loan officer side, in my opinion, comes in, is how do you make a borrower